Good evening to all of you. Welcome to our class today. I think last time we met on Monday, we went through what the examiner requires of us, okay, through the syllabus, okay. And today, as we had agreed on Monday, we shall begin our syllabus, okay. And the first topic is a simple introduction to what we call financial management. Okay, it's a simple introduction to financial management. Okay. So more or less this first topic, the introduction, okay, it more or less forms the basis upon which the other topic, okay, shall be based on, okay. So some of the concepts that we are going to be introducing in this first topic, we are going to build them up, okay, as time goes by, okay. Because either way, okay, whatever we shall be discussing, okay, is in this topic is what we are going to be topics, okay, as we go forward, okay. So that's my email address, okay, and I think we also have the group, okay, the WhatsApp group, in case you have any communication you'd want to convey, okay. So you can use the platform, the WhatsApp, as well as you can use my email address, okay. So we go straight to our first topic, the introduction. So as we had said on Monday, okay, simply financial management, okay, is the management of the company finances, okay, management of the company funds, capital, with planning, controlling of the company finance, okay, with the objective of trying to achieve some financial objectives, okay. So the company has financial objectives. So the management of company funds, the management of company capital, the management of the company finances, okay, in order to assist the company achieve that objective, to achieve that ultimate objective, that ultimate financial objective is what we do refer to as financial management, okay? That's what we refer to as financial management. Simply the management of the company funds, the management of the company capital, okay, be it long-term, short-term, whatever it is, but the management of the company funds, capital, money, finances, in order to assist the company achieve its financial objectives is what we do refer to as financial management, okay? Is what we refer to as financial management, okay? Which implies therefore, okay, one of the key things that we shall be discussing is what are these financial objectives therefore, okay? What will be these financial objectives that a firm want to achieve, okay? What are these financial objectives that a firm may want to achieve, okay? So we shall be also be discussing the financial objectives, the core financial objectives that a firm may be pursuing, okay? And as I mentioned, we shall be taking the perspective of a public listed company, okay? Not the SME, okay? So the conventionally, the term firm, okay, in financial management shall be referring to a public listed company, okay? Not the SMEs, okay? But in case the examiner, for example, want to ask you to discuss about the SME, then he's going to be asking you, okay, very explicitly that I want you to discuss about the SME, okay? But generally, the term firm refers to public listed companies, okay? Okay, let me admit some people here for class, okay? Now, the scope of financial management, okay? Generally, we do say that when it comes to financial management decisions, okay, or what referred to as what does a finance manager do play within the public listed corporation, okay, public listed company, okay? What are their key roles? What are their key functions they do play? What are the key financial management decisions that we expect that PLC must be taking, okay? Of course, the first is what we call the financing decision, okay? What we call the financing decision, okay? And what does financing decision involve, okay? Simply, financing decision is about trying to get to understand you as a finance manager. You have a capital need, okay? You have an investment, okay? You want to expand from market A to market B. You want to buy a new machine, okay? So all these investment, all these potential investment, they're going to be costing money, okay? They're going to be costing money. So therefore, you must get to know where am I going to be obtaining this money to finance this investment. Getting to know who are the different providers of capital that I expect to be financing this investment, that I expect I will be financing this particular investment. So getting to know the source of finance, for example, getting to know should I use, for example, debt financing? Should I use equity financing? Okay, should I use long-term capital sources? Okay, or should I use a short-term capital source? Okay, so that's going to be other financing decision. Okay, we shall discuss in the next few slides what that entails. Okay. The other decision is the investment decision. Okay, the investment decision. Okay, in the case of the investment decision, okay, so it's about now you want to make an assessment. Okay, as a company, there's some set of objectives we want to achieve. Okay, we want to increase our market share, for example, from the current 10% to let's say you are Airtel Kenya, just for the case of a class, okay? You're Airtel Kenya. Currently, you do control, let's say, 10% of the voice, the telecom voice market in Kenya. You have a strategy that you want to increase. We do want to increase that particular market share to that 5. Okay? So that therefore, as a company, for you to be able to achieve that particular objective of increasing market share, there's something that you must do. Okay, there's something that you will have to do. Okay, for example, you have to invest in new machineries. You have to invest in advanced technology. Okay, so all this is good. However, is it going to bring value to the company? Okay, now the analysis of that potential investment to make an assessment as to whether it will bring value to the business, okay, is referred to as the investment decision bit of it. Okay, and of course, it is within you as a finance manager who is going to be given that mandate, okay, of trying to analyze, okay, you make valuation, okay, of the potential investment the company can put its money in, okay. So that will be under the investment decision, okay. And then the other core decision is referred to as the dividend decision, okay, the dividend decision, okay. Now, what does the dividend decision entail, okay? Dividend decision entails you as finance manager, at the end of the day, you have to give return to the owners of the business, okay? Give return input, okay? You have to give returns to the owners of the business. Don't forget, shareholders are the ones who own the company, okay? So by the time they did invest in the company, they had prospect that we are going to pay money, okay? We are going to be paid for our investment, okay? We are going to be receiving return for the capital that I've put in this company. Okay, I'm a shareholder of let's say Kengen. Okay, of course, I anticipate that at the end of the year, Kengen is going to be declaring some dividend. Okay, so the decision that surround how much dividend do we pay do we pay to the shareholder? When we pay them, do we pay them interim? Do we pay them a final dividend? Do we postpone the dividend for this year? We pay them next year. Do we not pay dividend at all as a company? So all those decisions regarding the dividend decision making, it's you also as a finance manager it's your mandate as finance manager to make those decisions. Okay, and this therefore makes one of the key core part of financial management. Okay, as I mentioned, as we go along the way, we shall be discussing this as individual topics. Okay, we shall discuss them as individual topics. Okay. So let's begin the first one, what we call the financing decision. Okay. As I just mentioned regarding the financing decision, okay, here you have a potential investment that you want to make, okay. This investment is going to be costing you money, okay. You want to buy a new machine. What's the cost of this new machine? 10 million, okay. Now you ask a question, how would we finance this 10 million? Who is going to give us this 10 million, okay? As a company, should we go to the bank, okay? Should we go to the market and issue shares, okay? Should we convert ourselves from being a private company to a public listed company? Okay, so you have to determine, you have to make an assessment. Who is going to be financing? What are the financing? What are the financial alternatives available to you? Okay. Then, of course, the next thing I have to consider is that if we get to be financed by, let's say, by shareholders, okay, you have to qualify. Now, how much return do these shareholders want? They want to give me this 10 million cash share. But how much return do they want? Okay, can I be able to sustain the return they want? Okay, if you're going to be financed through debt, okay, the bank will be anticipating, will be expecting that every year or every 6 month, every 6 month period that you pay them interest. Okay, so you are therefore as a firm, you have to consider, can we be able to sustain payment of the interest? Okay, so you have to consider what the cost of this particular finance alternative that you want to take as a company. okay? So quantification of the cost of capital, okay? As well as also making a decision, do we use long-term capital source or do we use, for example, a short-term capital source? Well, the difference, long-term simply means, therefore, is that, for example, the repayment period, okay? If you're to finance a sale using that finance alternative, the repayment period extends for more than one financial year, okay? So in case we finance a sale using this bank loan, then you'll be paying interest this year, paying interest next year, 3 years from now. So the repayment period, okay, of the maturity, okay, of this finance alternative is more than one financial year. Then that is going to be able to classify as the short-term, as a long-term financials. Short-term by default, therefore, imply, therefore, it will be finance alternative where the repayment period, the maturity, okay, is not more, it's a maximum period of 1 year, okay? So as a company, you have to make a decision. Should I finance using long-term or should I finance using short-term, okay? So you make that decision. For example, okay, if I was to ask you, in case, for example, you have an investment that is going to last 10 years, okay? So this is a machine whose life is 10 years, whose useful life, or the economic life is 10 years. Should you finance using long-term or short-term? Oh, we got my question, okay? If, for example, we want to finance, we would want to finance, let me meet some people here. If you want finance, okay, an investment whose life is 10 years, okay, should you finance, okay, this is a machine. Just a simple example is that this is a motor vehicle, okay, that the company wants to buy, okay, whose useful economic life is 10 years. Do we finance with short-term financials or a long-term financials? Okay, you can unmute yourself and you answer, okay, from your end. Do you use short-term or do you use long-term?
I think putting into consideration the 10 years, I think we should use. Hello, yes?
Yes, Frankie.
I'm saying use a long-term capital.
So you use long-term capital?
Yeah.
Yes, we should use long-term capital. Yes, thanks, Frankie. Yes, we should use long-term capital. We have in finance, we have a concept called the matching concept. Okay, it's called the matching concept. The matching concept says that what you try to see when it comes financing a project, you try to see, can I be able to, what is going to be the payments that will be as a result of us taking this decision, okay? Then you have to match those payments with the receipts, okay? So you have to consider what receipts, what payment will I be making? I'll be paying the interest, I'll pay the dividends to the shareholder. So you have to match them, okay, with the receipts to be received by the investment. Would imply that if the investment is going to have a life of 10 years, then you have to match it with the payment side of it and the receipt side of it must match, okay? Otherwise, it does not make a sense. It doesn't make sense. You want to finance a 2-year project using a 10-year loan. That will imply, therefore, that by the end of year 2, the assets has already, the investment, okay, has already come to an end. But don't forget you took a 10-year loan, okay, which implies, therefore, you'll be paying interest beyond the investment time, okay? So therefore, you'll be paying interest for year 3 all the way to year 10. But you don't receive money. The investment has already come to an end, okay? So you don't want to do that, okay? So under the matching concept, you have to ensure that the two of them are in line. The payment you're making and the receipt you'll be receiving ought to match. If it's 5 year, 5 year, if possible, okay? If 20 years, 20 years, okay? We try to match the receipt and the payment, okay? The other thing you'll be able to consider, okay, is so-called whether an optimal mix of, whether do we have what we call an optimal capital structure, okay? Do we have what we call an optimal capital structure, okay? Now, capital structure, okay, is simply how does a company finance itself, okay? It's simply how does a firm finance itself, okay? If, for example, the company has assets worth 10 million, okay, the question is that how has company, who are the different capital providers who gave the company that 10 million to finance its assets, okay? So the composition of the various providers of capital, okay, that the company has used to finance its assets, both long-term and short, conventionally, the long-term assets, okay, who are these providers? That's what we call the capital structure of the company. Okay. In finance, we have a proposition that sometimes you can have a case where there is what referred to as an optimal mix of different financials. Okay. Let's take the case of debt and equity. Okay. That out of the 10 million that the company has, 10% of that finance came from debt holders. 90% of that money, the 10 million, came from the shareholder. Okay. Just for example. Okay? Let me just share my my whiteboard here, okay, to explain the concept of capital structure. Okay, so what do you mean by that? If, for example, currently the company has assets, okay, and these assets are their total investment value is 10 million, okay, so you have to consider out of the 10 million of asset company, how much was financed through debt, how much of it was financed through equity, okay. Okay, I see that it was financed 10% and 90%. Okay, that's how the company was financed. Okay, which implies therefore that 1 million, okay, came from debt holders, and 9 million came from the equity shareholders. Okay, to make a total of 10 million. Okay, that's how this company is being financed. Okay, now assume that an optimal capital structure. Okay, assume that we have what we call an optimal. Okay, now optimality means therefore is that at a point in time, we reach where the company can be able to minimize the cost. Don't forget, as I mentioned, the two providers, okay, these two providers, the debt, okay, and the equity, they don't give money for free. They'll be expecting return, okay. I will give you 10 million, I will give you $1 million, okay, but I'll be asking for example, for return, okay. Every year you need to pay me, for example, 20%, okay. As equity shareholder, every year I expect a return of, let's say, 22%, okay. This is for example, okay. So of course they don't give money for free, okay. They will be expecting some return they ought to be receiving for the investment, okay. So assume that the two combined, okay, the cost to the company for using money from the holders, equity shareholder is, let's say, 21%, okay, just for analysis, okay. However, assume that it is possible for the company to reduce the cost from 21%, okay, from 21% to, let's say, 18%. If that is possible, okay, where the company can reduce the cost, the cost they incur for the use of funds from debt holders, from equity shareholder, from the current 21% to 18%, okay, assume that for this to be achieved, the company needs to increase the debt, the amount of debt they use, and reduce the amount of equity they use, okay. Assume they need to reduce from 90% to, let's say, 20%. They need to increase the debt from 10% to, let's say, 30%, okay. Assume that can happen, okay. The company can reduce its cost from 21% all the way to 18% by simply the use of altering the amount of capital that comes from debt and the amount of capital that comes from equity. Okay, so they increase the debt and they reduce the equity. If that is possible, then of course you as finance manager, you have to make a decision when it comes to financing of the company investment. You have to try to attempt to take more of debt. In any investment, invest using more of debt as opposed to the use of equity. Because you need to increase the debt from 10 to 30. You need to reduce the equity from 90 to 70. So when it comes to making an investment decision, try to see, going forward, you're going to be using more of debt so that you can achieve this 30, 70. Okay, that's simply the trying to see what is the interaction of this finance alternative versus what is already existing within the firm. Okay. By the way, if you have a question, don't forget you're always free to ask me. Okay, as we go along the way. Okay, there's no need. I know there's no need for us to proceed ahead. We'll ask you. There's some ideas that have escaped you along the way. Okay, so always raise your hand. You know how that I called for raising your hand. Okay, so don't forget you always raise your hand up. Okay, I will see it and I'll ask you to ask your question. Okay. So that's on the financing, okay, on the financing decision, okay. When it comes to the investment decision, as a company, don't forget you say that you have objectives that you want to achieve, okay. You can decide that we want to increase our sales, okay, from 10 million to 20 million, okay. That's a good objective. We want to achieve this in the next 10 years, in the next 2 years, okay. However, you cannot just increase sales by, you need to invest in short, okay? You need to look for potential investment that is going to result to increasing your revenue base, okay? From 10 million to 20 million, okay? So for example, you may need to buy a new machine, okay? That is going to supplement, that is going to increase the production capacity of the farm, of the business, okay? So as a business, as a company, you have to consider, therefore, okay, how much value, okay, are we going to be receiving from this machine, for example, okay? We have decided, let's buy this machine, okay? But how much value are you going to be receiving from that particular machine? You make a decision, you analyze, okay? You quantify how much cash are you going to be receiving from this investment, okay? How much cash payments, what are the cash inflows that comes from this particular investment? What will be the cash outflows that result from us taking this investment, okay? How much value are we going to be receiving from this investment, okay? A simple method we normally use, okay? A simple method that we use in finance, okay? When it comes to analysis of the value you would be receiving from the investment, okay? Is, for example, you consider, what is the cost of this investment, okay? This cost is, let's say, $2 million, okay? That's the cost of the investment. Assume this is a machine, okay? This is a machine. These are one of those production machines that the company want to buy, okay? $2 million, okay? Then the next thing you have to consider is how much cash you're going to be receiving. What is going to be the net cash flow, okay, which you'll be receiving from this investment, okay? Assume that the net cash flow you'll be receiving from the investment is, let's say, 2.5 million, okay? In present value terms, okay? In today's value, okay? You're going to get money 3 years from now, but you want to get the value as per today's term, okay? So assume that the amount of cash you'll be receiving, the total cash you'll be receiving from the investment, from this machine, okay, over its life is $2.5 million, okay? So compare, what was my cost? 2 million. How much cash do I receive from this investment over its life, okay? 2.5 million. Should I invest or should I not invest in this machine? It's that is a good investment because you spent 2 million, okay, that was your cost. You got back 2.5 million. So what is remaining, okay, of course, is equal to, therefore, 0.5 million. So therefore, this is something good, okay, is bringing more than what you spent on the investment, okay. This is what referred to as the net present value method, okay, which we shall discuss later on, okay, the net present value method, NPV, okay. So therefore, as a company manager, you as a finance manager, then you have to make this analysis, okay? And of course, the main concern is more towards the quantitative analysis, okay? Quantifying the benefits, the financial benefits, and the financial costs that result from us making this decision, okay? That's your work as a finance manager, okay? So that's on the investment decision. Of course, definitely, okay? If you did invest, okay, the company bought a machine, for example, in the year 2016, okay? So let me call this to be an old machine. The company bought in the year 2016, okay? So now it's old. It's 4 years old, for example, okay? You may want to make a decision as to whether, should we, for example, dispose of this machine, okay? Should we dispose it of, okay? Should we replace it with a new one, for example, okay? The replacement. Now, all these decisions, they're part of the investment decision, okay? Whether we should dispose an old machine and buy a new one to replace it, okay? So all these are part and parcel of the investment decision, okay, which is you as the finance manager who is meant to carry out, okay? So that's on the investment decision, okay? Then you have what for as the dividend decision, okay? We have what as the dividend decision, okay? When it comes to making the dividend decision, as I mentioned, you have shareholder, okay? They do give money to the company, but essentially they expect return, okay? They are not going to, no one is going to invest his money in a project where they know I won't receive return, okay? So when they invest in a business, of course, they shall be considering how much return will I be receiving from this investment. Shareholders of Safaricom, okay? How much dividend, for example, is Safaricom going to pay us for this financial year, okay? So of course they'll be concerned about the return, okay? Is the share price going to be increasing? Or if I invest in this business, actually I'll be losing value through the share price decrease, okay? So of course you have to consider, okay? How much of the dividends, how much of returns are we making from the investment, okay? Therefore, you as finance manager, you have to make a decision. Should we in the first place pay the dividend, okay? Consider who are our shareholders, okay? Are they individuals? Are they corporates, okay? do they want the dividend? Okay, because in case they are individuals, then they do consider dividends as supplementary income. Okay, they do consider dividend as supplementary income, which implies therefore you as the manager, okay, you may want to pay the dividend to shareholder. Why? Because for them, they are considering the dividend as part of their income. So in case you don't pay them dividend, of course they are going to be in what they might be angry as per se. Okay, if they're corporates, okay, they are the companies that are your shareholders, then sometimes they don't want the dividend. Okay, so you as finance manager get to know who are our shareholders. Okay, are they more of individuals? Are they more of corporates? Okay, because that's to have a decision as to whether you pay or not pay the dividend. Okay. The other thing, okay, of course, you consider is when we pay the dividend. Okay, if you have to pay the dividend, do you pay a final or an interim dividend? Okay, do you pay a final or an interim dividend? Final simply means you pay at the end of the year when the financial statements are being presented at the annual general meeting. Okay, interim is dividend paid within the year. Okay, not at the end of the year. It can be paid at the end of 6 months, 9 months, okay, 7 months, whatever it is. Okay, but it is paid into the year. So you have to make a decision. Do we pay a final or do we pay an interim? Or do we pay both of them? Okay, an interim and a final dividend. Okay. So all these, therefore, it's you as a finance manager who is meant to take care of. Okay. So consider, for example, how much dividends should I pay? Okay, per share. Okay. Do I pay 2.5 shillings per share? Do I pay 0.25 shillings per share? Consider that. Okay. And of course, as you consider how much you pay the dividend, consider also the future. Okay. You don't want, for example, pay high dividends this year, then next year you can't be able to pay that dividend. Generally, we do say that you want finance managers, or for most firms, when it comes to paying the dividend, they want a situation where the dividend you paid this year, okay, in the next 2 or 3 or 4 years, we can be able to sustain paying the same dividend. Okay, so sometimes, some cases, you can say a company, it has made a lot of profit. Okay, however, they don't declare high dividends. Okay, one of the reasons, okay, over many reasons, okay, is if the company is not so sure that in the next few years they can be able to sustain pay that high dividend. So they are shy of, let's just not pay out of dividend this year. Okay, because we want to ensure that next year, okay, the dividend we have paid, okay, is sustainable. Okay, so consider how much dividend do I pay based on a number of factors. Okay, but one of them is, can you be able to sustain paying that dividend even in the future? Okay. Why pay the dividend? I think I already mentioned. Of course, you need justification as to whether paying the dividend has any impact to the shareholder. Okay. As I mentioned, in case they are individuals, then they are going to say, yes, we need that money, so it can have an impact on the value of the firm. Okay, because in case you don't pay the dividend, then of course the share price will go down. No one wants to buy your shares because they do consider dividend as part of their critical income. Okay, so in case you don't pay the dividend, then of course the share price will go down, and of course that will have an impact on the value of the business. If you don't pay if you pay them dividend and they don't want the dividend, the same thing applies. Okay, you are in court, like force them to take the dividend. And these corporates, okay, these shareholders who are corporate, they don't want the dividend. Okay, so in case they pay the dividend, then of course that might have an impact on the value of the business. Okay, so consider, get to know whether there's any value impact. Okay, the paying of dividend has. Okay. The units you should have done before, I think this, as I mentioned, it does not jeopardize you in case you did find some previous units a bit hard for you. Okay, you've already done, or we have already done, okay, the MA, okay, financial accounting, which you already done, and you also have done MA. Okay, so these are all referred to as the prerequisite units. Okay, but it does not mean that in case you did find these units a bit hard, that going forward they will also be hard for you. No. Necessarily, but the knowledge you've gained already there will be helpful in financial management. Okay. Now, as a company, as you mentioned, okay, that financial management, okay, is the management of the company funds, company capital, company resources, financial resources, with the aim of trying to achieve the company financial objectives. So of course, business firms, okay, corporates as they get formed, the owners of the business has a target. Okay, they have what they want to achieve. Okay, so they have all the corporate objectives. They are things that they want to achieve. Okay, so the objectives that a corporate want to achieve, is what referred to as the corporate objective. Okay, the corporate objective. Okay, as a company, okay, you as finance manager, you as the manager, not just finance manager, you as the managers or those charged with the governance of the company. Okay, you have to consider, what do we do in order for us to achieve the objective that have been set forth by our shareholders. Okay, so you have to put mechanism, you have to put in means, you have to put in structures, policies, okay, procedures, okay, that are going to assist you in achieving those objectives. So the means you have put in place, the procedure, the processes, okay, the system you have put in place in order for you to achieve those objectives is what referred to as the corporate strategy. Okay, how you intend to achieve the objective. Okay, the means you're going to be using. Also, that's what referred to as the corporate strategy. Okay. Now, when it comes to the corporate objectives, okay, they are quite diverse. Okay, they are quite diverse. Okay, we can have a case of financial objective. Okay, which is the core objective that the public listed company want to pursue. Okay, and you have of course the non-financial objective. Okay, so the two main type of objective, corporate objectives that a firm can pursue: financial and the non-financial objective. Okay. And they can include, for example, we have a scenario where the company want to, of course, profit making, grow the company profitability, increase market share, customer satisfaction, okay, to maintain reputable industry relations with your stakeholders, okay, achieve some cash flow position, produce high quality farm products. All these are objectives that a firm can pursue. Okay, all these objectives that a firm can pursue. Okay, of a key concern, as I mentioned, what referred to as the financial objectives. Okay, of the key concern are the firm's financial objectives. Okay, so you can classify the objective into, okay, we have the financial and you have the non-financial objectives. Okay, financial and the non-financial objective. Okay, now when it comes to assessment of the company financial objective, okay, now, what is the distinction, by the way, before we even go to financial objective? What's the distinction of an objective from being a financial as opposed to being a non-financial objective? It's simply at the end of the year, at the end of that time period, whatever it is, how do we assess how the objective has been achieved? If at the end of the year, at the end of the day, we are going to be using a financial, you're going to be using a financial metric measure, okay? For example, you're going to be using the amount of cash that have been earned from that particular objective, the profit earned from that particular objective. If it's about the money, let me just put it. If it's about the objective is about you're trying to determine how much money you have received, okay, then that is going to be more of a financial objective. Okay, so in case we are going to be assessing how the objective have been achieved using a financial measure, then it means the objective, first of all, was a financial objective. Okay. If you're going to be assessing the achievement of the objective using a non-financial measure, if you're going to be assessing how the objective or whether the objective has been achieved, if you're going to be using a non-financial measure, if you're going to be using a non-financial measure, then that implies that is a non-financial objective. Okay, so it's about how do you assess the achievement of the objective. Okay, how are you going to be assessing the achievement of the objective? Do you use a financial or do you use a non-financial objective? Do you use a financial or non-financial measure? Okay, if you're using a financial metric, okay, a financial measure to assess the achievement of the objective, then it means you are pursuing a financial objective. Okay. If you're going to be using a non-financial measure, okay, to assess the achievement of the objective, I mean, therefore, you are pursuing a non-financial objective. Okay, the key distinction between those two. Okay, because sometimes, as we shall see, it can be quite confusing. Okay, when it comes to knowing is this a financial or is this a non-financial objective. So the core financial objectives, which we shall be discussing, okay, for our syllabus, okay, there are three, okay. We have first is called the profit maximization objective, okay. That's one of the core objectives that we shall be discussing. The profit maximization objective, okay, to maximize the company profit, as the name suggests, okay. The next one is called the shareholders' wealth maximization. Okay, so we have here profit maximization, about the profit, and then you have what called the shareholders' wealth maximization. Then the other objective is the earning per share growth. So we shall be discussing three of them. Okay, so profit, okay, be it one, shareholders' wealth maximization, two, and you have the earning per share growth being the third objective, which we shall be discussing. Okay, those are three financial objectives which we shall discuss in detail. Okay. We have other financial objectives. For example, reduce the company gearing. Okay, profit retention targets. Okay, return on capital employed. Okay, so I'll also try, not in detail, but also try to mention on the return on capital employed as a financial objective. Okay, as well as, for example, we can have the return on equity. Okay, having a target return on equity. Okay, as a measure of the company. Okay, financial objective, return on equity. Okay, that's so called the ROE, return on equity, okay, as a financial objective. Okay, so let's go in detail to the first objective, the profit maximization objective. Don't forget, in case you have a question, anything concern, don't forget you are free to unmute from your side and you ask a question, or you can simply raise your hand up, then I'll get to notice you and ask you to ask your question. Okay, so don't shy away in case you have a question, by the way. Okay. Okay, so the first objective, okay, is called the profit. The first financial objective is the profit maximization objective. Okay, and as the name is suggesting, here what the firm is intending to achieve, okay, what the firm is intending to achieve is to maximize the amount of profit, to get as high as possible the amount of profit that the company can make over a given time period. Okay, over a given year, over a given month, okay, or a given quarter. Okay, the company can have a target that this is the amount of profit that we want to achieve. Okay, so it is about maximizing the profit the company is making. Okay, simple as that. Okay, this is one of what we call the old objectives of farm. Okay, it's one of the vintage objectives of the farm. Okay, profit maximization. Don't forget, as I mentioned, we are trying to take the perspective of public listed company. Okay, not the not NGOs, for example. Okay, not about the charity organization. Okay, not about schools, not about hospital. Okay, no, we are the key concentration is on the public listed company. And this business, they are there to make money. This business are there to make profit for the business, for the company. Okay. And how can the company maximize its profit? Of course, we try to see how can we maximize our revenues. Try to see what is our revenue base. First of all, how do we get the profit? How do we get profit of a business? Profit is equal to yes, Joseph. Unmute yourself.
Total revenue minus cost.
Of course, thank you, Joseph. Is going to be revenues minus cost minus expenses. Okay, thank you, Joseph. Okay, that the amount of profit, the profit, we say profit is equal to revenue minus expense, revenue minus cost. Okay, so that would imply, therefore, if we are to maximize the profits, then you have to look for how do I therefore attempt to maximize my revenues? How do I increase my revenues? Okay, at the same time, maybe I may want to see how do I decrease my costs. Okay, so you have to check what therefore makes the revenue, what therefore makes our cost. Okay, try to see what means can we put in place in order for us to increase our revenue. Okay, I don't know, Kasi, you want to try to have more advertisement. You may want to see can we produce high quality products. Okay, so try to see what can, or maybe Casino is about trying to offer more products in the market. Currently, we do offer 2 products. Okay, we do offer maybe voice and data only. Let's try to see, can we have M-Pesa? Can we have home fiber? Try to see how can you increase your revenue earning capacity. Okay, the first thing. Okay, then the next thing you have to consider also, as you increase revenue, you may be having a cost also increasing. So ensure that the cost doesn't increase at a faster rate than the increase in revenue. Okay, so you have to see what can we do in order for us to manage our cost effectively. It's about cost management. Okay, it's about cost management. Okay, so this is how we can maximize the profit. Okay, by trying to see how can we be able to increase our revenue. Okay, how can you be able to increase your revenue? What strategies can you put in place in order for us to manage our costs? Okay, that's about the profit maximization objective. Okay. Now, sometimes we don't see that. Go back. We said, if as a business you are to pursue this particular objective as your only sole objective, then you may have some roadblocks ahead of you. Okay, that this particular objective is a good objective, definitely. However, it might not be the sole objective that as a company you should ought to be pursuing. There are things, okay, there's some other better objective that you as a firm can pursue. So it has its own limitation, it has its own drawbacks, okay? So you have to consider, therefore, how can we be able to minimize, how can we therefore be able to, what are some of those limitations, okay? And what other objectives can we pursue as a business, okay? Which we will discuss in the next slide, okay? So the profit maximization objective has limitation. One of the limitations is that it is a short-term goal. It is a short-term goal, okay? Generally, when it comes to assessment of the company profit, what is the maximum period of evaluation? You want to make an assessment, okay? How much profit has the company made? What is generally the maximum period of assessing how much profit the company has made? I'm waiting. When it comes to assessment of the company profit, what is the maximum period of evaluation of this profit, of this company profit? Is it 1 week, month, 6 months? What is the maximum period of assessment? Yes, Sharon.
Okay, I can say it depends with the kind of product. There are those that you can, maybe you can give yourself a target of 3 months so that you see if you can measure the profit. Okay. There are those that you can give even 6 months. Yeah, and there are those that you can give, because in the market we have fast moving and slow moving products. So it depends.
Okay, I totally agree with you. So what's the maximum period for any product when it comes to assessing the profit? What's the maximum period?
Okay, I think for I can 6 months. 6 months to 1 year.
6 months to 1 year.
Yes.
Okay, thank you, Sharon. Someone, Joseph.
Oh yes. I wanted to say that the maximum could be could be 1 year.
Could be 1 year.
That's when, yeah, when accounting for the yearly profit.
Yes, I really agree. Thank you, Joseph and Sharon. Yes, generally, the maximum period of assessment of the company profit is going to be 1 year. Okay, which means, therefore, as a company, when you do set these targets, when you do set this objective, you are telling the company, you're telling the public, you're telling the market that if this is your sole objective, then this is what we want to achieve. For example, for a maximum period of 1 year. Generally, you don't see the company trying to say that this is the profit we want to make for the next 2 years. It goes to, and maximum is going to be 1 year, which implies, therefore, if this is your only objective, then what happened after 1 year? The question that remains. What happened? What will happen after 1 year? What will happen after you get that objective? You don't look beyond 1 year. That's what it means. Okay, that's what they call that. This is a short-term goal. Okay, it only looks for the next 6. It only looks for the next 6 months. It only looks for the next 1 year. Okay, so it's a very short-term goal. Okay, so because what will happen for the first year? What will happen after you have achieved the targets in 1 year? What is going to be the company status in 2 years, 3 years from now? So it does not go to that extent, okay? Then the other drawback is called it's an ambiguous goal. It's unclear goal. Okay, why do you think it's very unclear? Let me begin by trying to go back to our formula. Okay, when it comes to assessing the company profit, we say that profit is equal to revenue minus expenses. Okay, is revenue minus expenses. What profit assessment basis do you know? When you say that this is a profit, when you say that this is a company profit, there are so many bases of telling that this is a profit that we can use. And this objective doesn't tell us what base to use. So what profit assessment basis do you know? Do you get the question? When you say the company has obtained the profit, what are you saying? What profit base is that? Let me give you a hint. One of the profit assessment bases can use is the so-called the gross profit. The use of gross profit, for example, okay? The use of gross profit. What other base can you use? Sharon? Sharon?
Okay, I think I was thinking of maybe, but I think it's gross profit when I check on the sales and the cost of the goods. It's the same thing I had in mind, yeah.
Yeah, so what then, sorry?
Yeah, I think that's the only I had in mind.
Oh, that's the only, okay. So one of them is a gross profit. I actually agree that one of the basic can use is a gross profit. That triggers that this is the gross profit we want to achieve in the next one financial year. However, there's some other profit basis, not just a gross profit, that can be used. Mary, yes, Mary.
Net profit.
You can use a net profit. That's another base you can use. You can use a net profit. You can use a profit before interest and tax. You can use a profit after tax. You can use an operating profit. So there are so many profit assessment bases, okay, that the company can use. And this goal doesn't tell us which one are we pursuing, by the way. Are we pursuing the gross profit? Are we pursuing the net profit? Are we pursuing the profit before interest and tax? What are you pursuing? This goal doesn't tell us. It just tells us profit, maximize the profit. But which one profit? Which profit are you maximizing? So it's ambiguous. It doesn't tell us exactly how you're going to be achieving this. Okay? That's what I mean by it's unclear, it's ambiguous. Okay? Then let me discuss this other point here. Okay? On it ignores the welfare of other stakeholders. So who does it consider? So this objective ignores welfare for other stakeholders. So who is it considering? Who is going to be benefiting if the company pursues this objective? Who is the key benefactor?
Hello.
Yes.
It is the company.
Yeah. Thank you, Robert. Now, who exactly the company is benefiting?
Hello.
Hmm?
Oh.
Robert?
Pardon?
Who exactly in company is benefiting? Because there's a person in the company who is benefiting more than others.
Maybe the CEO.
The CEO. Okay. The CEO. How is he benefiting?
By a bigger profit, it means the company will grow more.
Bigger profit, the company will grow more. Totally agree with that. Because I totally agree with that. The more profit the company makes over time, of course, the higher its growth chances. Totally agree with that. Okay, but there's a person who is benefiting more. Let me try to answer this question. There's someone. Let me get some people here. There's some people here who is want to help out. Lillian.
Yes, profit maximization definitely is used to make the shareholders happy.
Yes, and it means the shareholders are the one. So in case this company was to pursue this as its sole objective, okay, then the key person who is going to be benefiting is the shareholder. The key person who is going to be benefiting is the shareholder. Okay, which implies therefore, if this company was to say that this is our only objective, what can happen is that the employees of the company, don't forget they are stakeholders, okay? The employees of the company are stakeholders, but don't forget the employee make part of the expense. The salaries you pay to the employee, the bonus you pay to the employee, this is part of the expense. And as we said, you want to minimize cost, okay? Which implies therefore, the company can go to the extent of even retrenching the employee because they are part of the cost, okay? I think you've seen this in the past, okay? And not even the past, even the current situation, okay? Where company trying to see how can we minimize our cost. One of the easiest ways they normally see is that let's retrain some of our employees. Let's try to see we do away with our employees. Okay, so it's a bit short-sighted way of trying to solve cost, try to reduce cost. But business do that, okay, more often than not. Okay, so where they do, for example, try to reduce the quality of the product. Okay, it happens. Okay, that means therefore you are ignoring this cash flow of the company. Okay. So all this do happen. So if you pursue this as the sole objective, it means you're only trying to, in quote, make the customer happy. Okay, then that's a problem for sure. Okay. The other thing is that it ignores what we call risk and uncertainty. Okay, let me give an example to explain this. Yes, Daniel, yes, shareholders are one of the people who do get to seem to benefit more. I actually agree. Thank you, Daniel. Okay, so it ignores risk and uncertainty. So let me explain this using my board here. Assume that the company has a target. So the company in the year 2020, the target profit, let's say is 20 million. The company target profit. So at the beginning of the year, the shareholders gave a target to the managers that, hey, we want to ensure that our profit for the year, our net profit for the year, for example, will be 20 million. Okay, so that's the target the managers have, the shareholder have put forth to the managers. Okay, assume that in the year 2019, okay, the company had a revenue of let's say 20. The cost the company incurred for that year, total cost the company incurred for that year was let's say 15 million. Let me see. Let me 10 million. Let me just put 10 million here for the sake of our argument. Okay, the cost the company incurred that year was 10 million. Would imply that for the profit, okay, for the year 2019 was 20 minus 10 to give us 10 million. Okay, that was the profit the company achieved in the year 2019. Assume that the company in the year 2020, okay, the company status quo remain. They make the same revenue, they incur the same cost, which implies therefore the profit the company was meant to report was 10 million. But assume that there was inflation in the economy. Assume there was inflation in the economy. What's inflation? Is the general increase in price of commodities in the economy. Okay. Assume that the economy experienced, let's say, 100% inflation rate. Okay. There was a 100% rate of inflation. Okay. Therefore, how much revenue? Assume the company, okay, they produce, if last year they produced, let's say, okay, the revenues for the last year in the 20 revenue, okay, was 1 million units, and the selling price was $20, okay, to give a total revenue of $20 million, okay. That's the case here, okay. The company produced 1 million, the selling price was 20, total revenue was 30 million, okay, what you have here, the 20 million half here, okay. Now, assume in the year 2019, the company produced the same 1 million units. However, there is inflation. And here the inflation is 100% inflation. The price in quote doubled. The price of commodity in the economy did double. Therefore, in the year 2020, okay, in the year 2020, what will be the revenue for the company? Yes, Sharon.
Kindly pardon the question. If in the year 2020?
If in the year 2020, the country experienced a high inflation rate. So the country experienced 100% rate of inflation. Okay?
Yes.
Assuming that the business continue, they produce only 1 million units that they produced in the year 2019. So they produce 1 million units. You got it?
Yes.
So therefore, what do we anticipate, therefore, if the company was to produce the same 1 million unit in the year 2020, what will be the revenue for the year 2020, therefore?
40.
Sorry? Sharon?
40.
40, of course it will be 40. Don't forget, inflation still means that the price of commodity increased. In this time around, it doubled by 100%, okay? Which implies, therefore, the revenue, okay, will be 40 million in the year 2020, okay? So the revenue is 40 million. Assume the cost was the same thing, okay? Assume that even the cost was derived the same way, okay? 1 million units, and the cost per unit was equal to 10, okay? To give us a cost equal to $10 million, this for the year 2019. Therefore, what is given the cost for the year 2020, therefore? So in the year 2019, the company cost was 10 million. And this 10 million was from, okay, this 10 million was from the 1 million unit the company produced times the cost per unit of 10, okay, to give us the $10 million as a cost for the year 2019. Now, in the year 2020, okay, in the year 2020, okay, what therefore will be the cost for the year 2020 if the country, don't forget, is still experiencing the 100% inflation rate? What's going to be the cost?
20.
Will be 20 million. Thank you. Okay, it will be 20 million. Okay, the cost will be therefore be 20 million. Okay, would imply therefore the cost here 2020 20 million. Okay, so it will be 20 million. Okay, to give us 40 minus 20 to give us 20 million. Okay, so this is the profit the company achieved in the year 2020. Okay, now you as a shareholder, you convene an AGM at the end of year 2020. You go through the accounts of the company. You see the company has made a profit of 20 million. Last year it was 10 million. What do you conclude? Has the company done well or not? Has the manager done well or not? So in the year 2020, okay, you as shareholder, will you be happy or not with what the managers have done? That's the question.
Will be happy.
Yes, of course you can be happy. Okay, if you're going to be happy that you're going to say, hey, the company has made a profit of 20 million. Now the question is, let's drill down. But in reality, has the manager done anything? Candy, you had a point.
I think what I can say, somehow the manager has done something to maintain the cost, but on the produce, but also due to it's just inflation that has made the prices go up.
Okay,
but
so
on the produce, yeah, they've maintained the same produce from the previous year. So
if, for example, you had promised the manager that in case you increase your profit above 10 million, I will give you a bonus. Okay, assume that there was that agreement that if your profit is above 10 million, I will give you a bonus. Should you give the bonus in the year 2020, therefore?
No.
Why not?
Okay, I think I'll try to, we need to see how 2021 will be.
Okay, but you gave a promise in the year 2019 that in case the profit for year 2020 is above 10 million, for example, or is above, or 10 million, then we shall be sharing with you the extra profit. do you share with the managers now in the year 2020?
I can give them not full, like a small bit of it, but not everything.
Okay, okay. Someone else with another view. What do you think?
As a manager,
Yes, who is this?
this is Joseph.
Yes, Joseph.
Okay, as a shareholder, I would be very happy with the result because, okay, the profit has changed from 10M to 20M. That's in terms of figures, but the real value of the profit has not changed. Yeah, due to inflation. So even if I'd given the managers if I told them that I would give them some value in a scenario where the profit changes, I mean, when the profit increases, I think I would not obey this because there's not been change in value of what was invested.
Okay, I totally agree. Thank you for all your arguments. I totally agree. Okay, the problem here is that, as we have mentioned, is that if you look at the figures as they are, you might even give a part of the back to the manager, say you did very well. Okay, the profit increased from 10 million to 20 million. The reality on the ground is that did they do anything extra? They did nothing. And, if anything, it's just the inflation that has occurred within the economy. Okay, they have done something good, as Sharon was trying to say, that at least they have been able to manage to maintain the cost. The cost has increased no further. But the reality is that you should not pay them. They have just placed you where you are last year in quote. Okay, they didn't go beyond. They didn't achieve the target they've agreed upon. Okay, they might seem as if they have achieved the target, but the reality is that they didn't achieve the target. Why? Because this goal, okay, ignores so many other risks. One of the key risks it ignores is the inflation. Okay, it is ignored. Okay, they don't try to consider that the true value of money in the year 2020, okay, have reduced. Okay, so the real value in quote of this profit is not 20 million, but it's 10 million. It doesn't take that into consideration. Okay, so it does not, for example, it ignores risk. Over and above that, it does not consider time value of money. This is 20 million, I agree, okay? But this is a year later, okay? Compared to 2019, this is a year later. So of course, you can't make a comparison between the two of them. But this value of the 20 million is not 20 million in the year 2019. It is a lower value, but you don't take that into consideration, okay? So this goal has its own what we call key limitations, okay? It has its own key limitation. And that's why we said, as a company, this should not be the only goal that you do pursue. Try to look for another better objective, okay, that you can pursue. Okay, in this case, therefore, we have recall the shareholders' way of maximization objective coming in. Okay, so it counts as a result of those drawbacks, okay, that you've just seen at the profit maximization. Okay, so the shareholder, okay, the manager of the business, they try to look for another better objective they can pursue. Okay, which in this case is about maximizing the wealth of shareholder. Okay. The question is that how can they maximize the wealth of shareholder? Okay, don't forget, as we said, that we are considering that this company is listed. Okay, the shares are trading in the stock market. Okay, the shares are trading in the stock market. KPLC, for example, Safaricom, for example, EABL, Nation Media Group. So the shares of this company, they do trade on the floor of the Nairobi Securities Exchange. Okay, they do trade on the Nairobi Securities Exchange. Okay. So the way that the managers of the company can be able to maximize the value of the shareholder is by trying to look for good investment. Okay, they need to see, okay, where should we invest our money? Okay, this investment you're going to be taking up. Okay, does it increase the value of the shareholder? Does it increase the value of the shareholder? Okay, does it have a positive NPV? Okay, like the way I've just mentioned before, the example I gave. Okay, we are going to spend 10 million to invest in a project. How much cash does it bring back in today's time? It brings back 15 million. And therefore, over and above what you spend the 10 million, you're going to be retaining an extra 5 million. That's a good investment. Okay. Now the market, we make an assumption. The market is going to be appreciating your investment. If you make good investment, the market is going to be happy with you. Okay, so the market is going to be appreciating. Okay, the deals you're making. Okay, the good value added investment you have chosen. So the share price therefore will be increasing. Okay, in line with the value you bring to the company, the value the project does bring to the company. If you take up a bad investment, okay, in short, it has a negative NPV. Okay, you spend 10 million, you got back 9 million. It means you're going to be losing in quotes. Okay, because you spend 10, you need to get more than 10. Okay, you can't get 9. Okay, so in case the company invests in a project that has negative net present value, negative NPV, then the shareholders will be decreasing. The market is going to decrease the share price. Why? Because the managers chose bad investments. Okay, so the market is going to be reacting to the value adding project the company does invest its money in. Okay, that is an assumption we're going to make in this case. Okay, but the market do appreciate the investment the company do chooses to invest their money in. Okay, so the essence is that we need to make an assessment. Okay, that as shareholder, okay, we would want to see that our wealth is increasing. So the first question is that how would we assess our wealth therefore? Okay, we assess the return to the shareholder. Okay, let me just give an example. Let me share my whiteboard here. Okay, so as shareholder, for example, okay, in the year 2020, 1st January, year 2020, I see that the share price, the value of a share, okay, was, let's say it was $15, okay. We want to make an assessment, okay, how much value, okay, has the manager created for us until today, okay. Today is 22nd of June, okay, 22nd of July, okay, 2020. Okay, assume that the share price is now 17.5. Would imply, therefore, if you're a shareholder and you want to exit from your investment, you're going to be selling one share for 17.5. Would imply, therefore, you spend 15, but at the point of disposal of your share, you're going to be getting 17.5. Therefore, you can say, therefore, the wealth created, okay, is equal to 17.5 minus 15, isn't it? Okay, and this gives, therefore, $12.5. So can you say this is something good? Of course, it's good. At least you're able to get 2.5 more, okay, compared to what you spent $15, okay. So this is what we refer to as the capital gain, okay. This is what we refer to as the capital gain. The increase, for example, in the share price between 1st of January and 22nd of July. So between the two dates, we can say that the amount of capital gains you have been able to make as a shareholder is 2.5. So 8.5, okay, minus 15, okay, or simply P1 minus P0, okay. By P1 here, I mean the share price at the end of the period, okay. P0 is the share price being the period, okay. So this gives us what we call the capital gain component, okay. P1 minus P0. P1 being the share price end of the period, like today, okay, and P0 is the share price beginning of the period, like 1st of January 2020, okay. That's give us a capital gain. Then also consider between 1st of January and 22nd of July, is there any dividend the company paid? Assume that on that 1st of March, okay, the company paid you a dividend of, let's say, 1.5, okay. So over and above, okay, the 2.5 increase in the value of your share, you also received 1.5. So there's a dividend here received, okay. So there's a dividend you received. Would imply, therefore, we can say the total return to you as shareholder, okay, the total shareholders return over the two dates, okay, shareholders return is equal to 2.5, okay, plus the 1.5 to give us the $4, okay, to give us the $4. So this is the total return to the shareholder, okay, which conventionally we can say it's P1 minus P0, okay, plus the dividend, okay, and that gives, therefore, the return to the shareholder. Okay, P1 plus P0, we divide by plus D, okay, give us the total return to the shareholder, okay? And this is what referred to as the absolute return measure, okay? This is what referred to as the absolute return measure. Trying to assess the return of the shareholder, what it referred to as on absolute terms, okay? P1 plus P0 plus D. P1 minus P0 plus D, okay? P1, okay, is the share price end of the period, okay? So I can just put it here. P1 is share price, okay, period end. Okay, P0 is share price P naught is share price, period beginning, and D, of course, is total dividend, okay, received between the period, received during the period, okay. So that's how we do measure the return to the shareholder, okay. The capital gain part, and you have the dividend part of it, okay. And this is what the absolute measure of return to the shareholder. Generally, we don't use absolute terms, okay. What normally we do is that we do use what refer to as the relative terms, okay, the percentages, okay, the percentages, okay. So if you're to use what refer to as the relative return measure, the relative return, it will be P1, okay, minus P naught, that is capital gain, okay. We divide by P naught. Don't forget, P naught is what you need to invest. In the month of January, you paid 15 to get the share, okay, plus the dividends, we divide by P naught, okay, and of course, we express this as a percent, okay, we express this as a percent, and that gives, therefore, the total return to the shareholder, this time around in percentages, what we refer to as the relative return measure, okay. So this is what referred to as the capital gain, okay, still remain as the capital gain, but now it is in percent, capital gain, and this will now refer to as the dividend yield, okay. We refer this as the dividend yield, okay, and that's therefore the total return to the shareholder over that time period, okay. P1 minus P naught give us a capital gain, okay. In percent, of course, we divide by the value of the investment beginning of time period, plus D divided by P naught, okay, and we express this as a percent. Clear question? Okay, so no question. Now let me give a question, okay, let me give a question. Give me 1 second. Okay, so as we do an example here, okay. Let me hypothetical case here, okay. Shareholder bought shares of Safaricom, okay, on 1st January 2020 for, let's say, 23.5 shillings, okay, 23.5. 23.5. Okay, on that 1st of March 2020, Safaricom paid dividend of 1.5 shillings per share. And a final dividend was paid, and a final dividend, I hope my handwriting is not too bad. And a final, if it is, let me know. And a final dividend was paid on let's say 1st of June It's 1st of July. Let me do 1st of July. Okay, 1st July 2020. 1st July 2020, amounting to let's say $1 per share, one shilling per share. If the share price on 1st June 2020 was 25, and on 22nd of August today was 26.6 was shilling. Let's see, was 26.6 shillings. Calculate. Okay, so calculate 1. Total shareholders return. Shareholders return on 1st June 2020. Roman 2. Capital gain. And dividend yield. On 22nd of June 2020. So here use relative terms. I hope you get the question. So this is just a hypothetical case that I'm trying to imagine. Okay, we can go through it. We attempt together. Anyone with a question? If you have a question, let me know for sure.
Excuse me, sir. I do have a question.
Yes.
Is it 26.65 or 26.6?
Oh, okay. No, this is meant to be a semicolon. That one.
Okay, thank you.
Yeah, so
Okay,
this is a semicolon, yes. Okay, I suppose that you have gone to the question and you have understood what the question requires of you. Okay, so the first bit is asking us to get the total return to the shareholder on 1st of June. Okay, so total return to the shareholder. By the way, in this case, for example, in Roman 1, I have been told you to use either relative term or to use absolute term. So in case there's no mention, always use relative term, okay, when it comes to giving the return to the shareholder, okay, the use of the relative terms, okay, not the absolute terms, okay. So let's answer Roman 1, okay. Hope you've gone through the question. If not, let me know, okay. I presuppose you've gone through the question. Okay, say solution. We can say that first is to assess the return to the shareholder. Okay, of course, it's P1 minus P0. Okay, plus the dividend. Okay, we are using relative term, so we divide by P0, and of course, we do express this as a percent. Okay, So P1, we want to assess the return to shareholder on 1st of June. Okay, therefore, the P1 is the share price on 1st of June. Okay, so on 1st of June, the share price will be told is 25. Okay, therefore, 25. The period beginning was on 1st of January, and the share price 1st of January was 23.5. Okay, so 25 minus 23.5. That gives us, therefore, the capital gain part. Okay, plus there's dividend. Okay, between 1st of June and 1st of January, the company paid a dividend. It was paid on the 1st of March. Where is this? Yes, the company paid on that 1st of March. The company paid a 1.5 shillings dividend. Okay, therefore, plus the dividend 1.5. Okay, we divide the share price beginning of the period, which is 23.5. Okay, and of course we express this as a percent. And you get how much to return to the shareholder, therefore?
$12.766.
Sorry, one point?
12.766.
1.766. Are you sure?
No, 12. 12.7.
Getting 12.76.
So you get how much?
12.76.
12.76. Yeah, that seems a bit close. 12.76%. Yeah, 12.76%. 12.06%. Yes. So else this here. Yes, immaculate. You get what do you get?
Actually, the question.
Mm.
I'm wondering why are we using 23.5? Because you said this is the end of period.
Yes, because sorry.
I'm asking beginning of the. Is it June or January or what does it mean to beginning of period?
Okay, we make an assessment. For example, this investor, when did you buy the share? When did you buy the share? When the period of your investment begin?
Okay, I understand now. All right, thank you.
Yes, it begins on 1st of January. Okay, yes, that's when it begins.
All right, thank you.
Okay, you're welcome. Now that's for Roman 1, okay, and you get 12.96, okay? You get 12.96, okay? So don't forget the percent. It's you multiply this entire the capital gain and the dividend, okay? You express as a percent. Okay? So I hope all of you got 12.6. Anyone who got stuck somewhere? Okay, seems no one got stuck. Now do Roman 2. Let me see how far you can go in Roman 2. So for Roman 2, we want to assess the capital gain and the dividend yield, okay? But this is time is on 22nd of July, okay? So you want to get the two components, the capital gain and the dividend yield on 22nd of July. What do you get? If you get an answer, you let us know how much you get. It's Faith. Faith?
Capital gain is 0.064.
In percent. Convert it to percent. Convert to percent.
6.4.
Capital gain 6.4%. Dividend yield
6.4.
It's the same, 6.4.
Yes.
Okay, so dividend yield is 6.4, capital gain 6.4. Combined, therefore, give us 12.8.
I rounded off.
So
it would be 12.7, 6 or 12.8.
But 6.4, 6.4, both of them, more or less.
Yes.
Okay. Thank you. Let's hear someone else. Thank you. Sharon?
Okay, for me, I'm getting the capital gain as 13%.
13%. Dividend yield?
And then the dividend I'm getting is at 11.
11%.
Yeah.
Okay, 11%. Okay. So we have someone else. Anne?
On my side,
yes,
I'm getting capital gain as 13.19%.
So 13.19%, okay.
And dividend yield as 10.63.
10.63. So okay. Thank you, Anne. Immaculate.
I'm getting capital gain as 6.38.
6.38%.
Same as dividend yield.
6.38%. Okay. Let me check maybe someone last person. Lolene.
Excuse me, sir.
Yes.
Okay, I think I'm getting the same figures. I rounded it off to 13.19.
Okay.
For the capital.
Okay. Don't worry. Yeah, don't worry. I see them. Okay. Lorraine?
Okay, for me, I'm getting the capital gain as 6.4% and the dividend yield as 4%.
4%, 4.
Yeah, the dividend yield 4%.
Okay, 4%. Okay, let's do it together. We see where you got it right, where you got it wrong. Okay. Now here, don't forget, when did you invest? That's the first question you need to ask. You need to answer, when does the period begin? Okay. Don't forget, the period begins on 1st of January. Okay, that's the catch. Okay, the period begins on 1st of January. And this time around, it ends on 22nd of July. Okay, so don't forget about that. Okay, 1st January. Okay, just a single time I hand 1st of January all the way to 22nd of July. Okay, on that 1st of March, the share price here was 23.5. The share price here is 26.6. On that 1st of March, the company paid some dividend. Okay, so here that 1st March there was dividend paid, which was how much? That 1st March to 1.5. Okay, 1.5. Then on 1st of July, there was another dividend that was paid. How much was it? Of 1 shilling. Okay, dividend was paid of 1 shilling. Okay, which implies therefore between 1st of January and 22nd of July, the total dividend paid, okay, was 1.5 plus 1 to give us 2.5, isn't it? Okay, to give us 2.5. Okay, that gives therefore the dividend bit of it. Okay, therefore P1 minus P0. Okay, divided P0 give us the capital gain. Okay, which will be equal to the share price is 26.6. That is 22nd of July, 26.6 minus the share price beginning 1st of January. Don't forget, minus 23.5. We divide by the share price beginning 23.5, and we express this as a percent to give us therefore what will be the capital gain part of it. Okay. The dividend yield, okay, will be the total dividend paid between those two dates, okay, which is 2.5, okay. So this is the capital gain part of it, capital gain, and this is dividend yield. Okay, 2.5 we divide by P0. So let me just use the formula so that for ease of revision. So it will be equal to P0. Okay, so D divided by P0, and we express as a percent. D is 2.5 total dividend. P0 is 23.5, and we express this as a percent. Okay, So what do you get to be the capital gain therefore?
$13.19.
So 13.19%, that will be the capital gain. Dividend yield?
10.6.
10.6%. And that's how you're meant to have done that question. Don't forget the catch, as I mentioned, is to know when does the period begin. Okay, beginning of the time period, okay, is on 1st of January, all the way until 22nd of July. Okay, then you consider in between how much has been paid in form of dividend. Okay, 1.5 was paid in the month of March, and 1 share was paid beginning of the month of July. Therefore, the total dividend paid in between those 2 dates is equal to 1.5 plus 1 to give us 2.5. Okay. All clear?
Yes.
Yes.
Okay. So Joseph, we can take a break. Joseph, is Joseph still in class? Joseph, you're still in class, isn't it?
Yes, I am.
Yes, yes. Should we take a break?
I think it will be ideal.
Okay. We meet at what time? We take a break, then meet at what time? Right now it's 7:22.
About 7:30.
7:30. Okay, so let's meet. Let's take 10 minutes. Let's meet at 7:33. 7:33.
Okay, thanks.
Okay, let's meet at 7:03. We take for the sake of part of question. Okay. Sorry, I took a longer break than what I was expecting. So that is one of the key financial objective that a company can pursue. Okay, the shareholders' wealth maximization. Okay. Let me go back to the notes. The next objective, okay, generally, you know, so this objective is a better objective to pursue if you were to compare it with, we were to make a comparison with the profit maximization, okay, because of those limitations that we saw with the profit maximization objective, okay. So it has advantages for sure. One of them, it considers welfare of all the stakeholders. For example, if we are taking the example of a bad reputation of the company, okay, if the company was to maybe provide poor quality service to the customer, okay, you have to look at, if the customer do complain, okay, you have to look at what is going to be the implication it will have on the share price. Of course, definitely the share price is going to go down, definitely, because the company cannot be able to make enough sales, okay. If the company was to mistreat their employees, okay, what is going to happen? Okay, of course, there'll be an implication on the share price, okay. If the company was to have an interference with their stakeholders, different stakeholders, okay, for example, the case of the suppliers, okay, if all suppliers are always complaining, okay, then of course all these negative impact, okay, may end up having negative, all this negative reputation the company will be having may end up having an impact on the share price, and of course by default the wealth of stakeholders, the shareholders, okay, what implies therefore, you as a company, you have to consider all the different interests of the different stakeholders you have in the company, the employees, the managers, the suppliers, the customer, the government, to some extent, you have to consider all these different stakeholders. If you ignore some of them, then of course you made up a case where there will be a negative market reaction, okay, to your mishandling of some issues we have with the stakeholders. Okay. Of course, considers what we call time value of money. It considers risk. Okay, I think we shall see this later on when we shall be discussing on the topic on valuation. Okay, we shall discuss a lot on valuation, how it does consider risk. Okay, considers risk and uncertainty. So we shall discuss this more or less in valuation. Okay. The next objective, the next financial objective is called the earnings per share growth. Okay, the earnings per share growth. Now, in this objective, okay, of the earnings per share growth, the shareholders, okay, more or less gives a target to the managers, okay. They do give a target to the managers that we want to have, first of all, what is earning per share? Let me begin there, okay? Now the earning per share, okay, is the earnings that can be distributed, the distributable, okay, part of the earnings of the company. If those earnings were to be distributed, okay, to the shareholders on per share basis, how much money can, what's the earning attributable, okay, to every equity share of the company? Okay, that referred to as earning per share is earning attributable to the equity, to the shareholder on to the equity share for every equity share that the shareholders hold on the company. Okay, and therefore the earning per share. Let me share my board. Yeah. Okay, we imply therefore earnings per share. We don't say earnings per share is given us, generally is given us the net income or the net profit. Okay. Sometimes the earnings, referred to as earning attributable. Okay, let me just put it here. Let me qualify it. We divide by the number of equity shares. Number of equity shares. Okay, so here by net income we mean what we call the earnings attributable to equity shareholders, to equity shareholders. This is referred to as the ETH. Okay, the earning attributable to equity shareholders. Okay, so generally is what is the distributable? What is the earnings that can be attributed to the equity shareholders? Okay, if that earning was to be distributed for every equity share the company currently holds in the company, how much is it? Okay, that referred to as the earnings per share. Okay. Now, in the earning per share growth, okay, on the earning per share growth, the shareholder can come with a proposal. Okay, the earning per share that we received last year, okay, for example, okay, was so earning per share. I call this earning per share for the year 2019. Okay, 2019 was, let's say 2.5 shillings per share. Okay, that was earning attributable to the earning per share for the year 2019. The shareholder has said we would want to see our earning per share growing by, let's say, 10%. Okay, so we want a 10% growth rate. Okay, in our earning per share. Okay, that's the target. Okay, now which implies therefore the earning per share that we expect therefore in the year 2020 for the group target to be achieved. Okay, ought to be equal to 110% times the 2.5. Okay, to give us therefore 2.75. Okay, I guess should be 2.75. Okay, to give us 2.75. Therefore, the earnings per share in the year 2020 ought to be at the minimum, okay, 2.75. Then what you're going to do therefore is that you as the shareholder, okay, at the end of year 2020, you come back to the drawing board. You ask the manager, what is the earning per share, okay, for the year 2020? Okay, don't forget this was the target. This was the target earning per share. But now what's the actual, okay, what is the actual? What is the actual earning per share, okay, that we have received in the year 2020? Okay, assume that the manager have been able to achieve a 2.65. Okay, the earning per share is 2.65. Okay, that's what has been the actual earning per share in the year 2020. Now you go back to the drawing board. You ask the manager, what was the target earning per share? The growth was meant to be 10%, which implies therefore we are meant to receive to have an earning per share of 2.75. It is true that the earning per share have grown because it was 2.5 2019, now it is 2.65 2020. However, you didn't achieve the target you had agreed upon, okay? Because the growth here, it is not yet 10% what you had agreed, okay? The minimum earned per share we are meant to be receiving is 2.75. You have received, you're given the earning per share, okay, a 2.65. It is not yet the target. It is not yet what you agreed upon, okay? It has grown, but not as per the rate you agreed with, okay? Would imply therefore we as the shareholder, more or less, if your bonus that were pegged on you achieving that target, then of course there should be no bonus you'll be receiving in the year 2020. Okay, So in itself, it can also act as the earning per share growth can act as a financial objective that a firm can pursue. Okay, that the firm can pursue. Okay, that's on the earning per share growth. Okay. Of course, okay, see, don't forget the net income, okay, don't forget this is pegged on, okay, is a profit measure, don't forget, okay, which implies therefore all the limitation that we mentioned when we're discussing on the profit maximization do applies here, okay, because this is profit based, okay, so all those limitations that we have already mentioned with regard to the earnings per share, with regard to the profit maximization objective also do apply here in this objective, okay. Okay, so you can go through that in the next 1 minute. Okay, I hope you'll be able to go through those extra notes on the earnings per share as a financial, earnings per share growth as a financial objective. Okay, now let's do a question. Okay, let's try to do a hypothetical question. Okay, let's assume this company. Okay, so example. The following are financial statement extracts. The following financial statement extracts. Financial statement extract of ABC company. Okay, so this is gross profit. Okay, it's in 1,000. Okay, assume gross profit of 10,000. Okay, more or less million. We have operating expense. Operating expenses for the company for that year. Same, they were 4,000. So there's an expense. Therefore, we can say that for the operating profit for the business, operating profit for the business is equal to therefore 6,000. Was 10 minus 4,000 to give us 6,000. Okay, additional information. Okay, so one, under the additional information for this business. Okay, the corporate tax rate. Corporate tax rate is 30%. Two, the company has in issue. The company has in issue 5 million shilling bank loan. No, it has in issue. Let me remove this. It has in issue 10%. 10%, 5 million shilling bank loan. It has in issue not it has bankroll is not issued. So let me correct that statement. The bank has the bank has borrowed. Let me use a term. Has borrowed. The bank has borrowed 10 million bank loan that matures in 2 years' time. The number of equity shares, the number of equity share in issue, equity shares in issue, let's say 1 million. 4. Not 4. Preference shares have also been used, in financing, company assets. Preference shares have also been used in financing company assets. The rate of dividend is, let's say, 5%, and the total nominal value of the shares, by these shares we mean preference share, is, let's say, 10 million shillings. 10 million shillings. Okay, 10 million. Okay, go through it a bit. Okay, so in last note, the target earnings per share, the target earnings per share growth, the target earnings per share growth rate is 10%, and last year's earnings per share was 10%. No, it wasn't 10%. Let me increase this to 30%. 30%. The growth in earnings per share, the target growth in earnings per share is meant to be 30%. Last year dividend earnings per share was 4.1 shilling. It was 4.1 shilling. It was 4. Let's do it 4. Okay. Required. Evaluate the earning per share growth target. Evaluate the earning per share growth target. Okay, so that's a question. Okay, so let me try to see if they can compress it to fit here. Yeah, it's like that. Okay, take 2 minutes to go through it, and if possible, attempt, by the way. Okay, we attempt the question. I hope all my handwriting is quite legible from your head. Yes, we are still on. I want to give you time so that you go through the question, you make an attempt before we try it out together. Confirming what you've done, okay? So this company, okay, we have the shareholder, they have given the management a target growth in earning per share of 30%, and we told that last year the earning per share was 4 shillings, okay, 4 shillings per share, okay. So which implies therefore by the end of the year 2020, for example, okay, the company earning per share ought to be equal to, okay, so the earning per share for the year 2020, okay. So earning per share, the target, okay, target, therefore to be equal to 130% times 4. Therefore, what will the earning per share for year 2020 if the target, if the growth was to be achieved?
5.2.
5.2. It's meant to be 5.2. Thank you. It's meant to be 5.2. So let's make an assessment. What has been the actual, or what is the actual earning per share for the year 20, for this year, the year 2020, okay? So first, the company, okay, this is what the company has achieved, an operating profit of 6 million, okay? So therefore, 6 million. So you can see here, this is, we extend, we do the analysis, you can say operating profit for this company is equal to 6 million. So of course we need to less the interest. Okay, we need to less the interest the company pay for that year. The interest the company is meant to pay. This company has a bank loan. Where is that bank loan? Yes, it has a 10%, 5 million bank loan. So therefore the interest the company is meant to pay for that year is equal to 10% of that bank loan. So this is working for interest. 10% in the amount they have borrowed, which is 5 million. Therefore, the interest they do pay is 0.5 million. So that's the interest they pay. So less 500,000, because therefore the profit before tax, okay, is equal to 5.5 million. Okay, that's the interest before tax. This company, it does operate in a country where the tax they do pay is a rate of 30%. So you have made a profit, of course you have to pay money to carry, for example, okay, and you pay that percent of your profit. So the tax they pay is 30%. Okay, so therefore, how much tax does this company pay? $1,650. So this company pays a tax of $1,650. Would imply therefore the profit after tax, okay, is equal to how much therefore?
3,850,000.
850. That's therefore is a profit after tax for this company. Okay, 3,850,000. Don't forget this company. They also have preference share, and don't forget between preference shareholder and equity shareholder, who get paid first? The preference shareholder get paid first. Okay, so therefore we need to first deduct the amount the company is meant to pay to the preferred shareholders. So they do pay dividends to them at a rate of 5%. The amount of money they have borrowed from them is equal to 10 million. Okay, therefore you can say therefore the dividend the company is meant to pay. So the amount they are meant to pay, the preferred dividend the company is meant to pay to them is equal therefore 10%. Is it 10% or 5%? It's 5%. Sorry, it's 5%. They're meant to pay dividend at rate of 5% of the amount they took from previous shareholder, 10 million. To give therefore the amount of dividend they're meant to pay is 500,000. Therefore, we less the preferred dividend. The preferred dividend to get paid before the shareholder. Okay. Therefore, less the preferred dividend, which is 500,000. Okay. Okay. This giver therefore the earning attributable to equity shareholder equal to that 330, that 350. 350 is the earning attributable to equity shareholders. Okay, that is for the year 2020, for example. Yes, Sharon, ask.
Okay, under the preferred dividend.
Yes.
Where are we getting the 10 million?
The 10 million.
The number of.
Here it is. Yes. Here. Let me. Oh, sorry. I've just rubbed off my working. So here, the nominal value was 10 million. So the nominal value of the amount, in short, the amount of financing that you as company have gotten from preference shareholder is 10 million. And you give them a promise that every year you're going to be paying you 5% of the money you've given to us, the nominal value of the share, the amount that they have given you. They will give you 10 million. Okay?
Okay, thank you.
Okay, welcome. Someone else had a question. Okay, somebody. Okay, so therefore the amount of preferred dividends you do pay to the equity shareholder, to the preferred shareholders, is equal to 500,000. Don't forget the preferred shareholder, the rank prior to the equity shareholder. Before you pay yourself any dividend as equity shareholder, you need to first pay the preferred dividend. Okay, so your earnings come after. Okay, the preferred dividends. Okay. Therefore, now we can have the earning per share. Therefore, the earning per share which this time we can call the actual, was equal to the earning attributable to equity shareholder, we divide by the number of equity shares, which is the 350. We divide by the number of equity share, which is 1 million, to give us therefore an earning per share of 3.35. We go back to our argument, okay? This is the actual. We need to compare with what was anticipated, what was the target, okay? And the target was 5.2, okay? Now you as shareholder, you go back to the drawing board, tell the manager, say, the target was 5.2. The actual is 3.35. Would imply, therefore, you have not achieved your target. What do you mean, therefore, you as manager, if anything, you didn't achieve our earning per share growth objective, okay? Which therefore you need to be reprimanded, okay? For your, in quotes, not making a good decision for the year because you didn't achieve the target. So if there was any bonuses that the manager were meant to receive for achieving the target, of course, there'll be, there should be no bonus repaid. First, because you didn't achieve, if anything, you even went below what was the earning per share that was there last year. Because last year it was 4. Now you even become worse off this year. Okay, that's therefore you meant to evaluate that the earning per share as a growth of as a financial objective. Okay, so those are the 3 core financial objectives that we are meant to discuss. Okay, question on that bit? Oh, okay, it seems that you all, yes, someone seems to have a question.
Can you please pardon what EATESH stands for?
Oh, what does this? This means earning attributable to equity. Let me just put it. Let me just put the entire word in here. Earnings attributable to equity shareholders. To equity shareholders. It's just an acronym, but it simply means the earnings that in case the company was to give dividend to the shareholder, how much is available to the shareholder? What is remaining? Okay, that will be the earnings attributable to equity shareholders. Okay, that's clear, Lillian?
Yes, thank you.
Okay, any other question? Okay, there seem to be no other question. Then fair enough. Then we